welcome back to another week of Manager's Thoughts. Today is March 17th, 2023. This is Kelly coming to you from Synergy Asset Management, and definitely not a boring week, so we're super excited to bring you this update. Alrighty, so a brief market update of how the equity markets have done this week. We saw all three major indexes, the S&P, the NASDAQ, and the Dow Jones, all turn positive by Thursday. Definitely subject to change on Friday depending on how stocks move. Definitely a volatile week with the VIX trading almost towards 30. Very high volatility this week. And so as of Thursday, March 16th, the S&P 500 ended up 2.7%, the NASDAQ ended up 4.7%, the Dow Jones ended up 1.3% for the week. Definitely surprising given that 2 out of 3 of the largest bank failures ever happened last weekend, and this is how the market is choosing to react. So a lot of that has to do with how the government and how the Fed, the FDIC, and the Treasury is responding, giving a backstop to those 2 banks that failed, but will be interesting to see how markets continue to digest this news. On the other hand, yields have completely crashed this week and last week as investors were fleeing into safety into U.S. Treasuries, and we saw the 2-year U.S. Treasury yield fall apart in the last 2 weeks or so, over 5% to just under 4% currently, as the 10-year U.S. Treasury yield also fell from about 4% to 3.5% currently. So will be definitely interesting to see how these continue to change and morph as the demand for treasuries changes. Another significant piece of the treasury yield moves over the last week or two is that the 10-year to 2-year treasury spread has significantly tightened, as you saw the 2-year treasury yield fall immensely while the 10-year treasury yield fell as well, but not as much. So you can see how the spread between the two, or you can see how the inversion, anything below 0 basically is inverted technically, and we moved significantly up from the 100 basis point inversion to just about 50 basis point inversion of the 10-year minus the 2-year treasury spread. Shifting into the economic updates of this week, on Tuesday morning, the BLS reported February CPI data, which increased 0.4% month over month in February, with categories leading such as shelter and airfare contributing to the monthly increase. On an annualized basis, CPI rose as expected at 6%, while core CPI rose 5.5%, both indicating the smallest 12-month increases since 2021. As investors grew less concerned with the weekend's banking crisis and reacted more positively to the CPI print on Tuesday, equity markets bounced on Tuesday following this news pre-market, with the S&P up over 2% in the morning and still up about 1.7% on Tuesday by close. CPI has really been falling off, you can see here in this chart, since about September or even summer of last year of 2022. And everyone, especially the Fed next week, is continuing to hope that it ticks down even more in the coming months. Following the CPI print on Tuesday, we also got the PPI print on Wednesday, or the Producer Price Index, that came in at 4.6% year-over-year growth in prices, while core PPI came in at 4.4% year-over-year prices, both of which came in much cooler than expected, and on a month-over-month basis, PPI actually fell 0.1%, while core PPI rose just a slight 0.3%. Falling food, warehousing, and transportation costs were actually among the top categories that pulled the total PPI lower on a month-over-month basis, but in both CPI and PPI, the annual inflation in the 4 to 6% range is still nowhere near the Fed's 2% target. Now, with that being said, we're still in a likely better inflationary period now. You can see that we've been trending downward for many months, but this is still not anywhere near the 2% goal. So we look forward to hearing the FOMC's take on these metrics as Powell speaks after the March Fed meeting next week on Wednesday. Following the PPI print on Wednesday, we also got retail sales for the month of February, where we saw sales fall just a slight 0.4% in the month of February. You can see they're down from the huge gains in January. Excluding auto, retail sales slipped just a slimmer 0.1% in February, and we can really see that consumers have not pulled back on spending, and the data surely follows that sentiment. For a little bit more context into that retail sales number, we have the nominal as well as the CPI adjusted retail sales data over the last 20 years. So here you can see that the data over the last few months is pretty much at the largest amount of retail sales that we've ever seen in the country, but that makes sense with economic growth, also with inflation. So that seems pretty logical though. When you adjust for inflation here, you can see that we are slightly off of that high of retail sales from late 2020, early 2022, but we're still pretty consistent with retail sales. It's not like retail sales have dropped off immensely at all with the economic uncertainty presented in front of us. So consumers are still strong, they're still spending near those record high levels, even when accounting for inflation. One last topic here is a banking update. So this has been an eventful week, full of updates, full of moves, lots of volatility in the markets, largely caused by financial stocks. So the Fed, the Treasury, and the FDIC all announced on Sunday that they were going to back all uninsured deposits at Silicon Valley Bank, as well as Signature Bank. So something they have not done in a very long time, really since the financial crisis. But markets have calmed a good bit while concerns of other at-risk banks have remained. So here you can see two stocks that we are watching just in terms of volatility and kind of higher risk is Credit Suisse. Obviously, that's been in the news a lot of issues internally with their banking, as well as First Republic Bank, which is a regional bank that has a high level of uninsured deposits, kind of right behind the levels of Signature Valley Bank. Both banks have accepted short-term liquidity funding in various methods and forms, and as of right now, are expected to stay intact as of Friday, March 17th, but only time will tell if any other banks, maybe beyond these two, will fall or face more difficulty as depositors are moving towards larger banks. We're continuing to monitor this banking situation, this really interesting time period. We have never seen such a time like this with the Fed funds rate increasing and affecting the balance sheets of these many banks across the country. So definitely an interesting circumstance here. As always, we are continuing to monitor each of these economic updates, these really unique financial conditions, and as we see new data, as new news stories come out with the banking system, as well as just the overall market and economic news. So we look forward to continuing to monitor diligently and adjust our portfolios per their mandates. Thank you very much for tuning in this week to Synergy's Manager's Thoughts Update, and we look forward to providing another update next week.